The year gone by, which is the year 2022, has been a year of twists and turns and peak and troughs. We started the year with the fear of inflation, but now fear of a slowdown and recession has started haunting us. So, what is in store for 2023? Could it be back to inflationary fears, or it could be the recessionary fears, which could really have impact on financial markets? Let's take that conversation forward with Adrian Lim. Needs no introduction whatsoever. He's got a deep understanding of long-term trends. He's a master stock picker and has been a long-term India bull. Adrian, fantastic to have you back on ET now. Thank you for joining us. It's been a hard year to call, Adrian. It's been a hard year to call for a variety of factors. Central bank policy action, how things are moving in terms of inflation and emerging market currencies. What's your sense for what lies ahead now?
I think it is more the same. You were saying that inflationary concerns were what we had in mind. And since that's persisted throughout the most of this year, softening of demand or recessionary concerns are now foremost on our mind. But they are very much two sides of the same coin. I think for India as a whole, it's done a very good job recovering from the restrictions that COVID placed it under. And I was visiting in as early as middle of this year in July, and India had recovered to a very healthy level of demand and commerce and vibrancy, something that was not always apparent in the rest of the region as well. So I think it's only natural with the recovery and the health of the demand that inflationary pressures would build, given the strains that you see in global supply chains and in the Ukrainian crisis. So it's only natural that we have now cause for concern on how deep and how prolonged the softening of demand would be going into 2023.
Adrian, on a relative basis, this year India has done exceedingly well. But on an absolute basis, the returns are not there. Do you think that really sets the tone for absolute double-digit returns in coming year?
I think it's very dependent on which vertical or which segment that you're talking about. I think in consumer discretionary and consumer staples, for example, the underlying health of demand has actually been pretty steady throughout the last few quarters. Whether this sustained strength will continue is difficult to predict with the inflationary pressures that we are now seeing. In certain segments, for example, in energy, you also see some strong numbers being posted due to the supply constraints and the margins being preserved by the high input prices as much of that cost is passed on to the consumer. So I think we have to go on a segment by segment basis. Things are promising enough that I think that India would be one of the markets where there's a better than average chance of strengthening, of more broad-based recovery and more broad-based earnings when compared to the rest of the region. But like you highlighted earlier on, inflationary and recessionary stresses remain present, and we will have to monitor that going forward. Some of these factors, though, are outside the country's hands. The region is very mindful, and the world is very mindful of where the Fed brings interest rates as well. So that's also another factor that we need to account for.
Adrian, the good old debate of India versus China has started again. The China bulls are of the view that Chinese markets are cheap, China will open up, and that really could be the best rate for 2023. The India bulls are insisting that there are structural problems with China. Chinese investing in China has not been a great experience for global investors, so they'll be forced to stay in India. Where are you on that debate? India bull or a China bear?
I'm greedy for both both the economies. I think that both economies are not perfect. There are some structural strains, some structural disadvantages in both these countries. But both of them have a lot of promise. And over the last decade or two, we have seen both of these countries move in great strides forward not only squeezing out very strong, steady, high levels of growth, but also spreading that quite broadly across its population and across its demographic base. So I am not of the view that you need to choose between one or the other. In the Asia Pacific region, if you look at our weights for the Asia ex-Japan universe, we have a lot in China and we have a lot in India as well. Um, and it's on a there are certain strengths that lead to the Chinese market. We like some of their giants in the internet and the e-commerce space. They have strengths in India, for example, where we like a lot of the financial groups. Some of the financial groups in India, we've done a tremendous job for not just majority shareholders but minorities as well. And we think that Chinese internet and Indian banks, for example, are not necessarily a zero-sum game where if you have one, you don't need to have any exposure in the other. They are not a direct trade-off, and we can see a case where over the medium and long term, both will thrive. So I think it's a valid question. I think it's an interesting question, but I don't think there's an easy answer for that question.
Over the course of next couple of quarters, are you looking at maintaining your India exposure, or could it be going up also?
I think we are maintaining where we are at this point in time, where in the regional portfolios it's a slight overweight, and then we also have single country funds, which are fully committed to India, so not sitting on a lot of cash. What happens over the next 2 quarters is really dependent on what we see in the markets. There has been a lot of volatility, especially in 2022 as well, and it's very like you appreciate, it's very difficult to predict the trend going forward. There are some macroeconomic issues that we need to be mindful of. So inflation, recessionary fears are some of those factors. And then we have to drill down to the sectors themselves and look at the strength of demand in the various segments, whether that's capital goods or consumer staples, consumer discretionary, or financial services, or software. So we need to be we need to be nimble. We like the stocks that we are backing, but the exact weights we may adjust around a little bit in light of the volatility and the uncertainty that we expect going forward.
Adrian, it's been a blowout year for Indian financials and especially PSU banks. I know you don't own PSU stocks in India, so I'll skip the part on PSU, but I'll talk about financials. As an investor, do you see that the Indian credit plus the banking cycle is there for next 2 or 3 years?
Yeah, it's been a sector that hasn't performed as well as we would have liked. We have positions and we're investors in HDFC Bank, Kotak Mahindra. These are banking franchises, banking groups that we like a lot. We've known them over the years, and they've always been very clear about what they want to do, which is to provide financial services of the best quality for the market at a reasonable price, and be mindful of the risks that they have on and off their balance sheets as well, and be mindful for their investors to make sure that they have a reasonable risk return profile. The environment itself is more difficult to call. The credit growth is not as exciting as it could be, as it should be, but we think that would recover over the next 2-year time frame. But then valuations are not as demanding as they used to be. When you go back 3-4 years, when we were in a more exuberant part of the credit cycle. So I think it's a reasonable trade-off. But we continue to back the Indian banking sector, but it has to be on selective stocks. We don't buy a basket of that follows the benchmark.
Clarity on MSCI on how HDFC Bank and HDFC Limited merger should be treated. Would you be open to increasing your weightage going beyond 10% in the combined entity?
That's possible. That's possible. We are mindful of what the benchmark is, but that doesn't dictate the level of conviction that we have in a particular stock. The other issue is that for some of our funds, we do have constraints on whether we can hold a single stock beyond 10% in some jurisdictions. So that's something that we need to revisit. But in terms of absolute quality, in relation to the market, we do like that combined entity a lot.
Franchise?
Sorry, I missed that.
No. Investor in both HDFC Bank and HDFC Limited?
Yeah, we're still before the announcement was made to integrate both operations. We have been investors in both HDFC and HDFC Bank separately as well. And looking ahead to the merged entity, we will continue to be investors in the bank.
I look at your public portfolio, what is in the public domain, and that portfolio has names like Nykaa, PB Infotech, or Policy Bazaar. Now, you invested into these stocks almost when they went public, and a lot has changed after that. So, how would you assess these businesses?
Well, they're very challenging businesses. They also provide an alternative in the Indian space that hasn't existed before. So the Indian internet boom attracted a lot of private capital over the last 5-8 years. Actually, it went back further back than that. We hold Info Edge as well, and Info Edge was the official grandfather, if you would, of internet stocks in India. But the recent round of public IPOs in the internet space has allowed the capital markets universe in India to provide new diversified offerings within the internet space. We like some of these business models. We appreciate that they're pre-profit with a 2-3 year time frame towards break even. So we are mindful of the risk there, and we have taken a relatively modest position. So unlike the likes of HDFC and HDFC Bank, which sometimes we are in aggregate close to 10% or even more, within our funds that invest in India only, collectively, all these internet stocks would not be more than 3% of the Indian funds. So they're relatively modest positions. But we go through the same diligence that we do for all our stocks. So we try and understand the business models, the market climate, the competitive landscape that they operate in. We try and understand the quality of the management team, the bench strength that they have to attack these markets and maintain their strategic advantages over a multi-year time frame and not just the next quarter or two. We look at for financial prudence. So in lieu of profits, the internet stocks that we have invested in have got big cash reserves where they are able to withstand a prolonged period of recession or demonstrate financial resilience in what could be turbulent times going forward. And we analyze and take all these into account. And therefore, we come to those names that you mentioned. Is it a difficult period of time over the short term? Yes, it is. Because some of these parameters, some of these operational parameters have become quite challenging during the last 12 months. But we think that these companies have a very good chance of executing on their business models? We think so, and that's why we remain invested in these stocks.
Decline when there were a lot of anchor investors and a lot of P investors who've been selling their stake down, some because of compulsion and some because of choice. Have you participated more? Have you increased your exposure more in any of the consumer tech or fintech Indian stocks?
Yeah, it's been a mix. I won't go into details here, but it's a mix. For those that have executed as they have guided us on and guided the market on, and they have delivered on the parameters that they focus on, we have been adding. And for those that have fallen short in the medium term, we have been reducing. But that happens to all the stocks that we invest in, not just the internet space. Maybe there's more anxiety surrounding the internet stocks given that they are pre-profit companies, but we hold them to the same levels of accountability for their business models and their execution.
Adrian, at abrdn Asset Management, you've taken big bets and you've been with those companies and with those sectors through thick and thin, irrespective of the short-term quarterly update, whether it's IT or banks. Do you see visibility for 3 to 5 years in some of the internet companies that you're ready to ride the thick and the thin?
We don't chop and change our names very often, but we do adjust the weights that we hold these companies for. So there will be adjustments to the portfolio depending on how they perform with respect to their market and their competitive landscape. There is not the same level of visibility in the pre-profit companies that you get with some of the more established companies like HDFC or HDFC Bank, for example. And that's why we need to moderate that risk by making sure that our active weights are more measured and usually smaller than some of the large cap holdings with better visibility.
Adrian, the other pocket of fear this time around is IT. IT stocks are getting smashed like no before. Even though IT companies are doing a buyback, markets are disregarding them. At what juncture do you think the risk-reward ratio for an investor like you becomes favorable in investing in large cap IT?
We've had we still have a large position in some of the stocks there. I appreciate that the sector is going through a difficult time, but we still have quite a bit in Infosys and quite a bit in TCS as well. So depending on your time frame, depending on what you're looking for, the markets are sometimes overly anxious in these difficult times where there's not a lot of visibility going for it. But over the medium term, stocks like, I'm not saying all IT stocks, but stocks like Infosys and TCS, we are confident will continue to generate very strong free cash flows, not just operational cash flows, but free cash flows that will cover their capex investment, their R&D, and their longer term structural cost consistently over the next few years going forward. So I hesitate to simplify the answer, but I think that for us, as long as Infosys and Tata Consultancy continue to focus on what they do well and execute like what they have done, we will remain investors in those stocks.
Adrian, when you are looking at your India portfolio, and if the starting point, let's say, is today, for next 3 to 5 years, do you think there is a strong possibility that we could get returns? I'm not looking at the currency return, but absolute returns between 12 to 15%?
12 to 15% per year.
Per year for next 3 to 5 years?
For the next 3 to 5 years. I think over the long term, you can say that the Indian market would do that. Could arguably do that, but you need to adjust for currencies. You need to adjust for other things as well. Our more immediate aim is to outperform the benchmark over the medium and long term, and depending on the risk constraints that are placed on us by our clients, that could be that degree of outperformance would vary and would be dependent on the time frame that they look out for. So we do expect the Indian market over the long term to do well, and as active managers, we do expect to work hard to make sure that we outperform that benchmark as well. But for an absolute 13, 15, 12% gain, that's a very difficult call to make. And I think in this current climate, nobody would guarantee numbers like that.
Adrian, 2022 in a sense has been a tough year for foreign investors. Markets like India have seen net outflows from the domestic investors, from the foreign investors. Do you see that changing in 2023 as the world normalizes and as interest rates in the Western world peaks out?
I think that's a decent chance that would happen, but it also depends on the recovery of not just one market as well. Generally, globally, you're seeing that the equities markets or equity capital markets have been having a difficult time as interest rates rise and the hurdle for performance has gone up. So there's a greater shift towards less volatility, a more prudent stance in people's investment portfolio, and a stance that will accommodate the raised cost of capital. I think India would stand a good chance of competing for regional or global capital, but it needs to demonstrate a resilient level of growth, and that balance cannot be taken for granted in light of the interest rate and inflationary pressures. There could be a return of capital. You can see that over the last 2-3 years, global capital allocation can be very fickle as well. So I think India is reasonably positioned for a recovery in sentiment, but the exact pace and the exact size of that recovery in sentiment is difficult to predict.
So on a net basis for 2022, was abrdn Asset Management a India buyer or an India seller? Just on a net basis for this year.
We've maintained an overweight within the Indian markets. We don't just being a buyer or seller is also a function of the assets under management that we manage. So I think the more useful, I'm sidestepping your question a little bit. I think the more useful indicator would be whether we are actively positioned positively in the Indian market or not, and that we still are.
Adrian, there are moments where when a market reaches a frenzy level, AMCs in the past, they have not accepted money for that fund or for that country. But in the India dedicated and country dedicated funds which you manage, and when you are talking to your clients, are you still open to accept India dedicated capital? Because that means if you're accepting capital, you are still positive on the market. You don't expect there is a bubble or a frenzy. That's the whole spirit of this question.
Well, it goes beyond that. If the market is reasonably priced, you would be buyers or you would position capital in the market that is attractive to you. Whether funds closed or open is also a function of what size and what scale they are in relation to the market that they participate in. And abrdn's been invested in India for more than 2 decades, but we are by no means we are by no means the largest, nor do we have a huge market share in a very deep and diverse Indian market. So no, we are still accepting money, if that's your question, and we are still positive on India.
That's Adrian Lim for you, giving his outlook for 2023. Says India and China both look very promising. He continues to bet on the HDFC franchise as well as the likes of Kotak Bank, and continues to have exposure in heavyweights within IT like Infosys and TCS.